We're doing, really fine. Aside from, trying to manage 3 kids at home and my wife doing homeschooling, I think we're doing really well, and business continues to operate normal.
We are luckily in a situation that our office is big enough so that we could spread the people. So social distancing is not a problem in this office.
We've been able to keep going on pretty unperturbed in all of this. We have not really been slowed down at all, which is important because the markets required that we were here and that we were alert and that we were agile and able to take decisions and action.
Home office is always possible, but I think being in the office is the absolute best way we can respond to our clients.
We're keeping the 2 meters of distance. We have disinfection stuff all over, alcohol and so on all over the place, next to the printer, next to the coffee machine, in the kitchen, in the bathroom.
Sometimes you keep hearing about all the cases and everything, and you go through these mood swings.
Today we just had a couple of hours ago an unexpected check by Swiss authorities, and they were checking how we're handling the situation, and this guy left the office with the words, "You can't do more." So obviously we are doing it okay.
In general, I have to say by nature, I'm a really skeptical person. Even more if I see there's a level of potential hysteria or sensationalism. So in the case of COVID, I have some question marks, to be honest.
I could see that some media coverage got out of control, or the reaction on that virus got out of control. Suddenly it had a different name. It was coming out of China, it was suspicious, we didn't get the real numbers or real data, or we didn't trust them. And at some point it was almost impossible for any politician not to do something. What I am missing so far in all the discussions and all the media coverage is that we don't have the denominator in that statistic. The denominator in this system means that we don't know how many people already having it, because for me that's one of the most important parts, because we know that with the standard flu on an annual basis we have up to 600,000 people dying of it. And of course it's sad, but that's the standard flu which comes each and every year and no one is talking about. So we have death cases this time as well, and it's sad as well. But I think it's so important to know the denominator, so how many people are already infected, because then we can really truly say if it was worse than the flu or not. I mean, I hope that at the end, after this is all over, it doesn't turn out that we have sacrificed our economies, we have sacrificed our prosperities for flu type of virus.
And it's going to change our view now a little bit, in that we have to say, where does globalization really make sense and where has maybe globalization gone too far? I think we're seeing it right now, for example, with medication, pharmaceutical products being mostly produced in places like India and China. So there is actually a bit of a supply constraint from these 2 countries. And I think this is a critical area where I think we have to be, in the Western world, self-critical in that we've gone too far in terms of globalization. Outsourcing for profit maximization comes at a certain price, and the price here, I think, was a higher risk of having supply disruptions in a crisis. So I think we're going to see certain critical industry, being moved more onshore again.
It's no doubt in my mind that we're going to have another virus or some sickness or some disease that's going to come again in the future. And my hope would be is that we'll be able to react quicker and understand what needs to be done sooner to not let it get this far.
I would hope that in the bigger scheme of things, people would maybe appreciate the luxuries of daily routine and the ease of life that we generally have more. it does appear to me that, you know, these days it's quite in vogue to complain and blame and to point fingers. And I think we should all remember how good we actually have it. One of the concerns I have is that we actually draw the wrong conclusions. You know, we just talked about the, you know, the learning points. One of the concerns would be that we actually go the other direction and we become even more state-central and statist. And you know, I think if I look back at history, one of the reasons that Switzerland, for example, has been so successful economically, socially, I think has a lot to do with the federalist approach, which actually provides a system and a structure where problems are solved close to the people that are concerned. Generally, as in any business, you know that problems are best solved by those people that really have the problems, know the details of the problem. The more you remove yourself, you know, if a CEO doesn't really know what's going on at the bottom, you know, of his, you know, on the bottom floor of his factory, and takes decisions across, you know, factories without really asking or inquiring or involving the people that really do the work and know what's really going on, those decisions will tend to be less good. And what we're seeing, I think, these days is that, for example, in the EU, there's more and more centralistic, bureaucratic type of decision-making and legislation. And I would hope that we don't now actually go down that road even further. I think that would create more tensions. I think economically it will not be wise. And ultimately, I think it will not be a safer world. I think it will be a less safe world if we go down that road further.
I think my immediate concern from this is really that a global healthcare crisis, as we have with this you know, virus spread, is being used and abused by you know, politicians around the world. And I think we're already seeing in some areas some political games being played here. So government and politicians trying to leverage that situation.
I'm actually scared 2 or 3 years down the road that somebody's going to say, oh yeah, that was passed as part of the coronavirus bill and now something's going to change. I felt that way very much with FATCA in 2010, where, I mean, that was basically, gosh, I forget even what the original bill was. I think it was an employment bill or something, and somehow they stuck FATCA in the back of there, and look at how that changed our lives.
A few things that came to my mind is, I mean, there was always a discussion of cash, having cash in societies, and usually people love it because it's freedom. And governments, they don't like it that much because it gives the freedom to the people to buy something and to place their money, which governments cannot see. One fear is that this situation will be used, or which will be misused by governments, to declare cash as not acceptable anymore because it transports viruses, for example.
We're basically looking at most portfolios being down roughly between 2.5% and 3.5%. So it's negative, it's never good, I guess, but then I think in relative terms, I think it has significantly outperformed the portfolio that most people have in the US. I mean, I see that a lot of American investors with their portfolios they keep at home, they were, you know, I think at the bottom of this first sell-off year, mostly of them were down roughly a third, so they lost 30%, 35%. They all went into this crisis, you know, completely unprotected, completely, you know, not diversified. So, you know, I think my hope would be that this is also now a good opportunity for us to show that there is a better way of doing it, basically.
This virus, actually, it was not the cause of what we are seeing right now. It was a trigger. The trigger could have been anything.
We felt that on one hand we had very high valuations by historical standards, and on the other hand we had slowing growth in the world. And that is maybe, I mean, aside from the corona situation, that already I think were, you know, two you know, factors that made us really concerned about the outlook for equity markets. And when we renewed the latest round of hedges, which we did on the 7th of January, Corona was really only the third point on our list of concerns we had back then. Priority number one was, our main concern was the rising tension, especially at that time with Iran, a looming crisis in the Middle East, and the high valuations of equity markets. So you can say now that we went into the crisis, being hedged for maybe the wrong reasons, you can say, but I think there were enough concerns already, and I think we managed that quite well.
The scope and the scale of this crisis is greater than what we saw in 2008. So if you look at the moment before the crisis hit, where were we at in 2007, 2008, and where were we in 2019, the beginning of 2020? And I think what you can see is very different places. If you look, for example, at the interest rates, in 2008, 2007, interest rates were still considerably higher. And that meant that at that point in time, central banks had much more maneuverability and much more options in terms of their monetary policies. If you compare the fiscal and monetary stimulus of going into the crisis, so the money and the fiscal stimulus that was pumped in, the amounts that were used to rescue the economy, we've already surpassed what was spent in 2008, and we're still only in the middle of this crisis.
2008 and today, I think it's a complete different situation. In 2008, we had a financial crisis. It came out of the real estate market, but it was very much isolated, more or less, to the US and to the financial and to the real estate area. Of course, we had side effects, but it was relatively small. Today, we have a situation that we have a global shutdown of the economy. Nothing works anymore. In 2008, people still went to work and the restaurants had open and factories were producing and life went on. It was a financial crisis which could be solved relatively quickly by providing enough liquidity and with monetary expansion. So I don't expect to get a V-shaped recovery in the economy.
If you look at the situation globally in terms of the structure of the economy, actually the economy overall was not doing so bad. And you had China, which was growing strongly and didn't have the high level of debt that they have today. Going into this crisis, China will not be the locomotive that will pull us out of this. They have huge debt. They've got imbalances as well. So a rescue from China, after they've possibly given us this virus, a rescue from China in terms of being the locomotive economically, that won't happen.
It's a little bit too early to draw conclusions in general or in detail, but a few things I think you can see already what will happen. And I think the biggest issue, what we can expect, what we will see is we will see more economic interventionism.
COVID-19 may accelerate certain processes, which to some degree may have been overdue. We've seen now close to 40 years of lower and lower interest rates. And that has led to all kinds of imbalances and has led to a huge debt load, publicly and privately. And at this point, there's not much further to go, right? I mean, in Switzerland, we have negative interest rates.
One thing is clear, that in this environment that we're going to move into, the kind of buy and hold and just ride the market, that is gone. And I think it's very important for investors to realize that you can't take for granted that the market is just going up and all the time, and you can always buy the dip.
So the strategy in general will be the same as before. I mean, we are focused here on wealth preservation at BFI. So what we do is first we identify the most appropriate asset allocation for our clients, and then combining it with risk management considerations. Where I can see opportunities right now, as I mentioned, it might be a little bit too early to draw conclusions, but it's in real assets.
Other asset classes we like are commodities. No one's interested in commodities these days. They've taken a huge beating, and we're taking a close look at that. Gold, we think, will benefit in all of this. You know, as inflation picks up, as interest rates start rising, and most of all, with all the money that will be pushed into the system fiscally and monetarily, gold will be a protector.
Clearly, additional liquidity, I think, is going to be great for stocks. We believe that we have some great opportunities, and maybe the approach here is, you know, we didn't really jump into the market right at the bottom of this first sell-off, because we believe that there's actually going to be a second leg in this current you know, correction, because typically major declines always come in 2 or even 3 legs. So, but we are already now working, you know, our focus has shifted forward already, and as we're preparing our shopping list, we definitely want to make use of this great opportunity. And we firmly believe that 10 years from now, I think we will look back and realize how absolutely fantastic buying opportunity this was here, for sure, yeah. We're seeing sectors that are starting to do much better than others. Among that is clearly technology. We're also seeing healthcare, consumer staples, then also some of the utility companies. I think we're also starting to see commodity companies finding a bottom and doing well. These are the sectors that we expect to do well going into the future. And it's interesting here because some sectors that, you know, people kind of thought were, you know, being risky in the past, but actually you'll be the new staples of the future. And I think technology is a great example, because a lot of the big tech companies, you know, they have actually been doing extremely well during the recent, you know, crisis. So something that was perceived to be risky has actually, you know, proven to be very resilient in times like this. And that is another reason why I think sector allocation is really key going forward.
I would be very cautious concerning financial assets, and the biggest financial asset class, it's bonds.
It's going to be hard to invest in bonds looking forward. You know, I think there may be some short duration, you know, high quality bonds, but they'll be closer to being like liquidity or cash. But the times during which you could hold bonds and kind of benefit from yields going lower and lower, we've kind of come to an end of that. That said, you know, if you ask me how long will interest rates stay low, I think actually it could be quite a while. You know, to come out of this with the debt load, that debt has to be financed. And the moment we go up with interest rates, we're into the next phase of severe trouble. And so, yeah, will be interesting. We're definitely in interesting times. And at BFI, we're in a way, you know, we're aware of that. And we humbly accept the fact that this is really hard. And we hope and pray that we're going to take the right decisions moving forward. We're also a little bit excited because this is a once-in-a-lifetime experience of dealing with that kind of crisis. And we're intent on doing a good job. And our motto as always is, you know, is to protect and grow what is rightfully yours. So that's what we're here to do. And proud and feel obligated to continue doing exactly that.